In 1989, a bizarre economic anomaly occurred that defied the laws of physics. The land beneath the Imperial Palace in Tokyo, a modest 3 square kilometer garden, was valued at more than all the real estate in the entire state of California combined. Let that sink in. California, the Golden State, home to Silicon Valley, Los Angeles, massive agricultural empires, and thousands of miles of pristine coastline, was worth less than a few patches of grass in downtown Tokyo. During the late 1980s, Japan was an unstoppable economic juggernaut. It was poised to do the unthinkable, overtake the United States, and claim the throne as the world's supreme financial superpower. But then, the miracle vanished. For the past 30 years, Japan has been locked in a state of permanent, quiet economic stagnation. It became a country of ghost towns, deflation, and zero interest rates. But don't let the silence fool you. Behind the curtain of Japan's stagnation lay one of the most powerful hidden gears of modern finance. An invisible, trillion-dollar pipeline of cheap money that became a major hidden engine of Wall Street's massive valuation boom, helping fund the S&P 500's historic rise and providing cheap leverage for global financial institutions. It was the ultimate financial cheat code. And right now, that system is breaking. Most people believe that the unprecedented boom of the S&P 500 over the last 40 years was driven purely by Silicon Valley's innovation and American economic dominance. We are told that Wall Street's trillion-dollar tech giants simply outcompeted the rest of the world through sheer genius and superior capital. In short, America won the economic war because its system was better. But this comfortable narrative ignores a glaring mathematical reality. It doesn't explain why Wall Street crashed by trillions in a single morning on August 5, 2024, when nothing had changed in Silicon Valley. It doesn't explain why American hedge funds are suddenly panicking over administrative decisions made inside a central bank in Tokyo. And it doesn't explain why a tiny interest rate hike in Japan can instantly vaporize American wealth. When Washington exerted enormous pressure in 1985, Japan eventually agreed to help revalue its currency, triggering a massive asset bubble in Tokyo. When that bubble burst in 1990, the Bank of Japan chose to keep interest rates at zero to fight persistent domestic deflation. When rates hit zero, Wall Street hedge funds discovered a way to borrow trillions of yen for cheap to buy U.S. assets. And when that cheap money pipeline suddenly began to shut down in 2024, the entire global financial structure started to shake. Therefore, the historic 40-year rise of Wall Street is not merely the product of free market capitalism because American companies are simply superior. Wall Street became heavily dependent on the Tokyo loophole because it was fueled by an invisible trillion-dollar pipeline of cheap debt leveraging those American giants. Today we will understand how this grand financial illusion was constructed, how it fueled the biggest bull market in human history, and why this trillion-dollar glitch is now threatening to destabilize Wall Street. On September 22, 1985, the finance ministers of the world's 5 largest economies, the United States, West Germany, Great Britain, France, and Japan, quietly slipped into the luxurious Plaza Hotel in New York. On paper, it was a diplomatic summit. In reality, it was a high-stakes geopolitical realignment, and Japan was at the center of it. By the mid-1980s, Japan was an unstoppable manufacturing empire. Its factories were flooding U.S. markets with high-quality cars, electronics, and microchips. They were cheaper, more reliable, and technologically superior. From the Rust Belt of Ohio to the boardrooms of Detroit, American corporations were screaming at Washington for protection. Japan was buying up America's crown jewels, from the Rockefeller Center to Columbia Pictures. Washington's diagnosis was simple: the Japanese yen was too cheap. This made Japanese goods mathematically impossible to compete with. Under intense diplomatic pressure from the United States, Japan eventually signed what would be known as the Plaza Accord. They agreed to systematically intervene in currency markets to depreciate the US dollar and artificially appreciate the Japanese yen. Within just 2 years, the yen doubled in value. What used to cost $1 to import from Japan now costs $2. Overnight, Japanese exports became too expensive. The economic engine of the Japanese miracle had been dramatically slowed by its closest ally. To prevent a catastrophic domestic recession, the Bank of Japan made a fateful decision. They slashed interest rates to 0. And in doing so, they opened the gates to a speculative mania that would forever change global finance. The zero interest rate policy of the late 1980s triggered a massive speculative asset bubble in Tokyo. Real estate and stock markets inflated to absurd heights. But when that bubble popped in 1990, the Japanese economy entered a multi-decade freeze. To combat this chronic deflation, Japan's central bank made a sovereign monetary decision to keep interest rates at 0% and eventually, in 2016, pushed them to negative 0.1%. It was a domestic policy designed to heal Japan's own economy. But Wall Street quickly realized they could leverage this low-interest environment for their own benefit. It is called the yen carry trade, but in the back rooms of New York and London, it was simply known as the ultimate cheap cash pipeline. The process works like this. A multi-billion-dollar Wall Street hedge fund borrows billions of yen from a Japanese bank. Because Japan's interest rates are near 0, the cost to borrow this money is practically nothing. The hedge fund immediately converts those yen into US dollars. Now they have cheap capital. They can take those dollars and buy US government bonds, which pay a guaranteed 5% interest. They borrowed at near 0% and they are earning 5%. That is a highly profitable, low-risk return, generated by capturing the interest rate differential between two countries. Or if they want astronomical returns, they use that cheap cash to leverage their investments in high-flying US tech stocks, Nvidia, Apple, Microsoft, Tesla. Of course, the massive valuations of companies like Nvidia or Apple are built on real, revolutionary technology and monumental earnings. The yen carry trade didn't create these companies, but what it did do was act as an accelerant. It provided cheap, abundant liquidity that pushed Wall Street valuations much higher and much faster than they would have otherwise gone. While the exact size of the yen carry trade itself is heavily debated, some economists estimate that global leveraged positions, cross-border assets, and financial derivatives tied to cheap Japanese debt had swollen into trillions of dollars of global exposure. Wall Street had benefited enormously from Japan's low-rate environment. But in finance, as in physics, every action has an equal and opposite reaction. And in late 2024, the laws of gravity finally caught up. Post-pandemic global inflation finally breached Japan's borders. The cost of imported energy became unbearable. The Bank of Japan realized that if they didn't defend their currency, the yen would face a severe collapse. So, to protect their own domestic economy, they raised interest rates in July 2024 to 0.25%. 0.25%. It sounds trivial, but to a global financial system heavily leveraged with cheap yen debt, it was a systemic earthquake. The cheap money pipeline was suddenly disrupted. Because Japanese rates were rising, borrowing yen became more expensive. At the same time, the yen began to rapidly strengthen against the dollar. Hedge funds that had borrowed trillions of yen realized their borrowing costs were soaring and the debt they had to pay back was getting more expensive by the second. The crash of August 5th, 2024 was a perfect storm. It was not caused by the carry trade alone, but rather a chaotic convergence of a rising Japanese currency, a surprise Bank of Japan rate hike, the panicked unwinding of global loans, growing fears of a U.S. recession, and building anxiety over high artificial intelligence valuations. When all of these factors collided, trillions of dollars in global markets evaporated in a single day. To pay back their Japanese loans before they went bankrupt, Wall Street funds had to raise cash instantly. They had to sell their most liquid, high-performing assets. They sold Nvidia. They sold Apple. They sold Microsoft. On August 5th, Japan's Nikkei index crashed by 12.4%, its worst single-day drop since the Black Monday crash of 1987. Across the ocean, Wall Street suffered a historic meltdown. Trillions of dollars of market capitalization evaporated in a single morning. It was a stark, terrifying revelation to every American investor. Global finance is deeply interconnected. The great American bull market is heavily dependent on monetary policies decided halfway across the world. And this was only a warning shot. In 1985, at the Plaza Hotel, the United States exerted enormous pressure to save its own industries. Japan agreed, setting off a chain of events that led to decades of ultra-low rates. But history has a dark, poetic way of balancing the ledger. 40 years later, the very monetary policies Japan adopted to survive have become major leverage points that can shake Wall Street. The cheap debt that helped fuel the modern American tech boom is now a variable that could trigger its next major correction. Wall Street wanted cheap leverage, but they forgot the most fundamental rule of finance. There is no such thing as free money. There is only money borrowed from someone else's future. And sooner or later, the creditor always comes to collect. If you want to understand the invisible structures of debt and power that truly run our world, subscribe to Fiscal Relics. Let us know in the comments. Is Wall Street already too late to stop the crash? Thank you for watching.